And welcome back to another Econ Podcast with Mr. Hagan. On this Econ Podcast, we continue to talk about investing. Please remember that this video is not designed to give investment advices for educational purposes only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, so I want to continue talking about the random walk theory, or also called the efficient market hypothesis. And in the efficient market hypothesis, or the random walk theory, we said that one of the things that is important is managing risk. And we talked about managing risk on some previous videos dealing with specific stock risk and market risk. We'll come back and talk about those on some future videos as well. What is also important for investing in the random walk style is investing in what are called mutual fund companies. So let me just describe briefly what a mutual fund is, what a mutual fund looks like, and then how a mutual fund can help us keep our fees low, which is going to be the third and very important point of random walk investing. So we said that it is important for individuals, according to the random walkers, it's important for individual investors to be able to have a diversified portfolio. Okay, but for any one individual, having a diversified portfolio could be very difficult. For example, if you wanted to invest in the S&P 500, the largest 500 companies in the United States, you would have to buy 500 stock in 500 separate companies, and that would be very difficult for any one individual to do. So instead, what we do is this. So down here we have individuals, and these would be people like you and me. We have jobs, and we're earning a paycheck, and we want to take some of that money, some of that paycheck that we're earning, and we want to invest it. And we'd like to have a diversified portfolio. We'd like to invest in a lot of different companies, and some of us have more money to invest, some of us have less money to invest, whatever. We have all these individual people who would like to be investors. So the question is, how can all these individual people get access to professional management and diversification? Well, what we do is all of us, instead of going out and buying, stock in McDonald's or Microsoft or Apple or Google or whatever the company is, instead of going out and buying stock in those individual companies by ourselves, we send our money to what are called mutual funds. So all of us might have different amounts of money that we're going to send to the mutual fund company. Okay, we earn our paycheck, and then we send money into the mutual fund company. Some big mutual fund companies, there's a lot of these. Okay, you can look these, get a list of them online. There's tons of them. Some big ones are Vanguard, Fidelity are two of the biggest. Pioneer and Putnam are some other ones. There's lots of different mutual fund companies. Okay, and so what you could do is you could individually take your money, each of these individuals, send their money to one of these mutual fund companies. Okay, and then the mutual fund company, look what the words are here, mutual and fund. So mutual is all of us sending our money in together, and the fund is just the money. So mutual money, money together, mutual fund. And then what the mutual fund company can do is they go out and buy companies. They go out and buy shares in companies like Microsoft. They go out and they buy shares in company like IBM. They go out and buy shares in companies like Apple. They go out and buy shares in companies like whatever, all kinds of different companies. And they could buy hundreds and hundreds of companies that would get you, the individual investor, access to professional management in lots and lots and lots of different companies, giving you a diversified portfolio. Okay, so that's just kind of how a mutual fund company works. They accept the money from all their individual customers, and then they take all that money together and they go out and they buy shares in companies out there in the world. Okay, so that's kind of how a mutual fund company works. I mean, that's a super basic explanation. Now, some of these companies are what we call actively managed. Okay, some of these mutual fund companies use active management. What does that mean? That means that they actually hire a money manager who's going to get paid money to decide what companies to invest in, Microsoft, IBM, Apple, etc. They're going to choose for us what companies to invest our money in. And they might use a firm foundation strategy to do that. Probably most of them do. Some of them might use a castle in the air strategy to try to do that. We've talked about that before on previous videos. But these active managers will use these different investment philosophies to try to figure out what companies to buy for us in order to try to earn us the highest possible return. Now, we've been talking about the random walk theory, and they're more skeptical of these active managers being able to outperform the market averages. So there are also mutual fund companies that will engage in what we call passive management. Passive management means that they're not going to hire a manager to go out and try to pick which companies are going to do best and then invest in those companies. That's not what they do. The passive managers, these are the guys who engage in index investing. Okay, these are the guys that are going out and buying indexes such as the S&P 500 or the total stock market index or whatever index they choose to buy. So what they do is they would be a mutual fund company. They would take your money and they would simply take your money and divide it up into all the different companies in the S&P 500 index. Okay, and that, by the way, the S&P 500, that was the first index fund that was actually started by Vanguard, a guy by the name of John Bogle. And so you had the S&P 500 index fund, and so some investor would send their money into Vanguard, and they would take that guy's money and divide it up by all the 500 companies in the S&P 500 index, and then that's it, done. Okay? So you would have to choose whether or not you would want to invest your money in an actively managed mutual fund company or in a passively managed mutual fund company. And a lot of these companies will offer both. They'll offer active managed funds and passively managed funds. Some of these will charge what's called a load. A load is a sales charge that you pay up front to a salesperson to go find mutual fund companies for you. A no-load company means there's no salesman. No one's going to come to your house and help you choose what mutual fund to invest in. You would have to do it on your own. You would have to go choose the companies that you're going to invest in. But the advantage of that is you do not have to pay a load. You don't have to pay a sales charge up front. Okay, so that's part of what we talk about when we say as a random walker of keeping fees low. So let's look at an example. Sorry about that. Let's look at an example of this. So first of all, some funds charge loads or upfront fees, which I just mentioned. They could be as high as 5%. Some are lower than that. Some are higher than that. So a 5% load, what does that actually mean in reality? That means only 95% of your money actually gets invested. Okay? So if you give them $100 to invest, only $95 actually gets invested. The other $5 would go to the salesperson as a fee or a charge for them helping you. So let's talk for a second about what helping you actually means. What does that look like? Well, essentially what it means is this. Here's your trade-off. You could pay somebody a load, a 5% fee, let's say over here, and you pay them that fee in the hopes that they will invest in actively managed funds that will effectively pick the correct companies that are going to outperform, and then you'll make more money on your investment. Now, random walk people are very skeptical of this. The random walk guys will say nobody really can outperform the market, so why would we pay them this 5% load? The random walk guys are going to be more like over here. The random walk guys are going to say, hey, nobody can beat the market. Okay, so if you can't beat the market, just join it. Just buy the whole market. Buy the S&P 500. Buy the total stock market index fund, whatever, and don't pay a load for it. Keep your fees low. That's the idea of the random walk. So let's see how much of a difference that this would actually make in reality. So let me just get rid of that. So let's say this. Let's say you have $100,000 to invest, and you're going to invest that money for 30 years, and you're going to get a 10% return on your money. So normally what would happen is we would use this formula over here, P times 1 plus R to the T. Now I don't want to get too mathy here, but my P is this is the principal, or the amount of money that we invest, which in this case is going to be $100,000. Okay, so we have $100,000. That's my principal, plus 1 plus R. So that's going to be taking my 10% rate of return and writing it as a decimal, which would be 0.1. That would be 0.1, would be writing that as a decimal. So we're going to say 100,000 times 1 plus 0.1, 1.1. And then raise that to the number of years that we're going to invest, which in this case is 30 years. So I'm actually going to pull out my calculator, and I'm going to do this calculation. So we're going to take 1.1 raised to the 30th power and multiply that by the $100,000 investment. And in 30 years, that investment would be equal to, the number I get is 1.7 million. Actually, it's going to be $1,744,940. Okay, that's if I do the no load. Okay, I get my full $100,000 is invested. Now, let's come over here and let's say I do pay the load. If I pay the load, then not all of this principal is actually going to get invested. So I would have to do this. I would have to do 1 minus the load, which in this case we'll say is 5%. So 1 minus 5% means only 95% of my money is actually going to get invested, times the $100,000, which is the amount of money that I was going to invest, times the 100,000, times, the rest of this is the same, 1.1 raised to the 30th power. Okay, so 0.95 times 100,000, what that means is instead of the full $100,000 getting invested, only 95,000 is going to get invested. Where did the other $5,000 go? Because I gave $100,000 to my broker to invest for me. Well, the other 5,000 went to him. It was a fee that he charges, and he gets to keep that money. Okay, and let me back this up here a little bit. I just need to give myself some room here. So let's come back to this 95,000. So I have my 95,000 times 1.1 raised to the 30th power. Okay, and let's do that on the calculator. So $5,000 went to the broker. I only get to invest 95,000. So that's going to be 1.1 raised to the 30th power times 95,000, because only 95,000 of my money actually got invested. So I end up with 1,657,693. Okay, almost $100,000 less as a result of paying the load. So that's what the load cost me. Yes, the load only cost me $5,000 up front, okay, because I invested only $95,000 instead of $100,000. But at the end, at the time that I take the money out 30 years later, I will have almost $100,000 less because of paying that load up front. All right, this has been Mr. Hagan on another Econ podcast. Thanks for joining me, and we'll see you on the next Econ podcast.